millions and millions of checks are being written, millions and millions of payments are being done, right, every day. So you can't actually settle it on a transaction by transaction basis,
yeah.
right? So you need to have a settlement system whereby all these payments are clubbed and net amounts are basically transferred across banks. And this is what is called clearing. Reserve Bank, that's the name central bank.
Right.
Because in that sense, the Reserve Bank becomes the central bank where all banks have an account with. So when money has to move from bank A to bank B, it moves in their accounts with RBI. And what's important is, when two banks have to settle amongst themselves, they use their accounts with the Reserve Bank, with the central bank to settle amongst themselves.
Yeah.
That's where central bank comes in. Our app, on our app we can tell the customer to initiate a payment transfer or payment, transaction at any point in time, and it will be acquired and it will be settled.
Last week, we started speaking about central banks, and we spoke about their evolution. We spoke about the roles that they play, and particularly in monetary policy. This week, we'll continue this conversation, cover other aspects of the central bank's functioning, and dive into some very interesting anecdotes. Welcome to another episode of Open Dialogue, and joining me today is Neeraj Gambhir, and we look forward to a great conversation. Neeraj, welcome to the show.
Thank you.
So Neeraj, last time we spoke about monetary policy. Let's move tracks and talk a little bit about payment systems. And maybe let's start with just take, let's say, check payments. Can you describe for our viewers what does it take for a check to get cleared? And you write a check, you are in bank X, I'm in bank Y, you write a check, I give it to my bank. Tomorrow morning, money is there in my account. Now, what goes in the background when this is happening?
Yeah, so the best way to think about this is to say that, let's say you have an account with bank A, I have an account with bank B, and I need to make a payment to you.
Yep.
And I will write a check
Yep.
on my bank account.
Yep.
And give it to you.
Yep.
You will take that check, present it to your bank.
Yes.
Right? Your bank, in a very technical sort of way, will come back to my bank and say, hey, your customer has written this check. Can you please, first of all, check, is the customer genuine, is the check genuine? And does the customer have indeed the amount of money that he's written a check for? And if yes, then please transfer that money to me so that I can give it to my customer.
Sure.
Right? So there has to be a transfer of this money between the bank A and the bank B for the money to get credited to your account. Right? And this transfer of money between bank A to bank B on account of their customers is effectively payments.
Right.
Right? And millions and millions of checks are being written, millions and millions of payments are being done, right, every day. So you can't actually settle it on a transaction by transaction basis,
yeah.
right? So you need to have a settlement system whereby all these payments are clubbed and net amounts are basically transferred across banks. And this is what is called clearing.
Right.
So you must have heard of this concept called, oh, my check has gone into clearing.
Right.
Right? So what is clearing? Clearing is basically a service provided by someone, typically called a clearing corporation, to take these checks and present it to the respective banks and make the money transfer between the respective banks so that the money can move from person A to person B, right?
So where is the RBI in this?
Well, where is RBI in this?
Yeah.
How does the money move from bank A to bank B?
Yeah.
Actually, what happens is both bank A and bank B maintain an account with the Reserve Bank.
Yes.
Right? So in that sense, Reserve Bank, that's the name central bank.
Right.
Because in that sense, the Reserve Bank becomes the central bank where all banks have an accounts with. So when money has to move from bank A to bank B, it moves in their accounts with RBI.
Right.
Right? So that's where the central bank comes into play. So it's effectively acting as a central counterparty or central clearing house for all the payments that are happening between various banks within the country, right? And that's the role of RBI in terms of a central bank.
So essentially in this process, Bank A which is my bank, is sending my check to the RBI. And by the way, along with my checks, all other checks that have come, not only to Bank B, but to all other banks. So all of them go to the RBI. Similarly, Bank B, which is your bank, is sending their checks. And RBI perhaps creates a list saying, look, now Bank B owes Bank A X rupees and sends all the checks to Bank B. And then Bank B says, okay, I will move so much money from my account to Bank A's account. And then Bank A subsequently takes that money, distributes it to their customers, and which is where money comes to me. And similarly, on the other side, Bank B has collected money from all their customers and, deposited that into their account or made their account good or whatever else. So that's how this entire processing works.
So effectively, you need to have a central clearing agency which does all this work, right? And a account with the central bank where these settlements happen.
Absolutely.
Right? And it is this part of making the settlements happen is where Reserve Bank or central bank comes into play.
Absolutely.
Right? The clearing house functionality per se, the operational part of clearing house is typically done by different agencies. Sometimes it's different companies, an entity setup, and sometimes it's a function of a part of the central bank, right?
Sure.
That's not important. What's important is when two banks have to settle amongst themselves, they use their accounts with the Reserve Bank, with the central bank to settle amongst themselves.
Yeah.
That's where central bank comes in.
Yeah. And if you take any of the other payment systems like we have UPI or IMPS or NEFT, broadly work on similar principles.
At the heart of it is basically settlement of money between the banks.
Between the banks.
Right?
Yeah.
That is the part that rests on central bank's balance sheet. That's one aspect of it. The second aspect of it is the rule making.
Right.
Right? Rule making about what the check should look like. It's a payment instrument, so it has some security features, right? What is the kind of timings on which these payments can be done, right? What are the timelines for settlement of the payments? Nowadays, payments are electronic. You're not writing checks anymore, right? You are sending the money electronically to each other. At the heart of that electronic payments is payment systems such as RTGS, real-time gross settlement system, NEFT. These payment systems are basically operated by the central bank. It's electronic infrastructure. It is operated by the central bank, which provides you this functionality like UPI, etc. Right? So, operating of these payment systems, making sure that they're resilient, they're available all the time, there are no downtimes, and there are rules about how to use this is also what the central banks do, right? So, for example, in India, we have a separate act governing this aspect of RBI's function. It is called Payment and Settlements Act of 2011, if I'm not wrong, right? So that act basically governs this entire functionality of the central bank of monitoring payments. And many participants, not just the banks, but many participants are governed by the rules and regulations that Reserve Bank makes under this act.
Under this act, absolutely. And in India, by the way, kind of Indian payments is extremely evolved.
That's right.
Like you will find almost all payment types are real time or near real time. They are available 24/7, by the way. Now,
even on a holiday.
Even on holidays, right? And by the way, this is true not only of UPI, but now of, I would say, almost all payment instruments.
That's right.
And they are available either free of cost or at very marginal cost.
That's
so
right.
the friction in transferring money is not very high either. So how did we get to this? Like, how come we solved this problem?
A lot of this is basically innovation brought in by the central bank itself.
Right.
Right. A lot of this started by setting up what is called a real-time gross payment system in the country, RTGS. Right. So RTGS was effectively the first big change in the payment system, because prior to RTGS, it used to be physical check clearing, right? But RTGS made that large amount of money movement electronic.
Right.
And followed up with RTGS was our small value payment system, which is called NEFT, National Electronic Funds Transfer System, right? NEFT. So these are the two large value, small value payment systems which are being run by the central bank, by Reserve Bank. And as these payment systems were made, available for a longer period of time, available for even holidays or weekends, the ability of banks to provide the same services to their customers increased, right? So unless and until central bank took the initiative, it wasn't possible for the rest of the system to do that, right? But effectively what happened was, because NEFT is not now available 24/7, our app, on our app we can tell the customer to initiate a payment transfer or payment, transaction at any point in time, and it will be acquired and it will be settled, right? But at the heart of it is the fact that NEFT is available 24/7 or RTGS is available 24/7, right?
Yep. And also the fact that these are all quote-unquote public infrastructure.
That's right.
And which means it's not run by a private entity which does not have a profit motive. And because there is no profit motive, there are either low charges or no charges at all for...
effectively you can say that's a unique feature of Indian system.
Right.
It's not necessarily so if you go to US or if you go to, European countries.
Or China.
Because I'm not sure what China charges or Chinese banks charge. But in most of the developed world, the transaction value of making these payments is still fairly high, right?
Yeah, it's quite high.
But in India, I think one of the things that central bank has done is basically focused heavily on creating a low-cost public infrastructure, right? So that it encourages electronification of the payments in the economy, right? And it has encouraged people to use these tools. Otherwise, if the cost of doing a electronic transfer is very high, then people will still be stuck with, check payments, etc., because they are less costly. So effectively, you have digitized the economy, you have digitized the payments by giving them this incentive of low-cost payment infrastructure.
Absolutely. Which, by the way, kind of the derivative impact of this on the economy will be substantial, because otherwise money is stuck between bank accounts for 2 days, which in this case is near instant, and kind of people can go on with their lives.
Yeah, so it reduces the frictional cost of the money, right?
Absolutely. We'll move on, Neeraj, to the next role that the central banks play, which is of banker to the government. And so helpful to understand firstly, what does this mean? What is a banker to the government, and why does the government need a bank?
Yeah, for example, government is also an economic entity. It's an economic agent, as we call it, right? And if you think about it, governments collect taxes. Governments use these taxes to do various, expenditures, payment of salary to the government employees, providing various services, creating infrastructure, spending for the infrastructure. So effectively, government is an economic agent, and it does require to deal with money for that purpose. There are two parts to it. One is the fact that it needs to make payments and it needs to collect taxes, right? So it's a core banking service, and that core banking service requires a bank.
Right.
So the government typically, for its most part, actually deals with the central bank.
Right.
So central bank becomes the transaction banker of the government. The accounts of the government are maintained by the central bank or with the central bank.
And this, by the way, is for the central government.
Can be for the state governments.
Or for state governments as well.
Yes, it depends. Jurisdictionally it can be very different, but in India largely it is for the central government.
So state governments, I understand, kind of have accounts with commercial
banks.
The
commercial banks, yes. So it's really about the central government, right? The second aspect of this is that central banks, there is a gap between the amount of money that they collect by way of taxes and the amount of money that they want to spend on social welfare, etc. Right?
Right.
And that gap, what is called fiscal deficit, needs to be financed.
Yeah.
So, like I said, if I go back to the Bank of England example, initially many banks were set up to finance the exchequer, right? That was the main purpose.
Yep.
But over a period of time, the financing per se has reduced.
Right.
What has become more important is to help the government raise this money from private markets.
Right.
So instead of central banks loaning this money to the government, you're raising this money from the private markets or private individuals to fund government's deficit. And that facilitation aspect is what the central bank handles.
So in this role, the central, like as an example, the RBI would issue or help the government issue bonds, let's say.
Well, bonds is one form.
Yeah.
What we call is it acts as the debt manager.
Right.
Right. It's the public debt manager.
Office, yep.
Right.
Yep.
The public debt manager's role is, so for example, in India, the central government needs to borrow roughly 12 lakh crores every year.
Right.
The latest number, right? An estimated number, 12 lakh crores. Now, the Reserve Bank of India decides that how it borrows that money, at what frequency it borrows that money, what are the rules of issuance of these government bonds, right? Who can participate, who cannot participate. It also facilitates creation of a secondary market by running an infrastructure or by helping the clearing corporation run an infrastructure. So there are a lot of these associated activities that the central bank does, which go a long way in helping the government raise money for its use, right? So therefore, not just the transaction banker, but also raising of the liquidity,
right.
Raising of the funding, right?
Right.
And in that sense, it's a government's banker.
Understood. Great. Moving on to the last function, which is the regulatory function. So I think it'll be helpful to understand what the central bank does when it comes to regulations and what its roles are.
Yeah, it's very interesting that the regulatory aspect of this, the regulatory aspect of a central bank's role, is a fairly recent phenomenon.
Right.
Right? I mean, if you look at the history of central banking, it has mostly evolved around, lender to the government, providing credit to the economy, etc. The regulation aspect came from what is called lender of last resort functionality.
Right.
Right? So, and that's where the US Federal Reserve kind of comes into play. As the central banks were being called upon to stabilize the banking system, if you, let's say, you have a banking system which is in turmoil because there is a confidence crisis, right? The central bank is called upon to stabilize the banking system, and it provides liquidity to those banks who are in trouble.
Yep.
Right? So it's actually using its own balance sheet to lend money to the banks who are in trouble. Now, anybody who does that would like to know what this bank is up to. Wants to make sure that this bank, whom it is going to lend money to bail them out in a period of stress, is actually doing kosher business, right? So that was the start of regulatory aspects, right? And over a period of time, obviously, it has evolved because now central banks are providing the lender of last resort functionality to the entire banking system. And in exchange for that, they are basically making sure that the banking business which is being conducted by these institutions is a kosher, stable banking business.
Right.
Right.
And there are two aspects to that, I guess. And I guess also different central banks differ. So one, as an example, in India, the central bank is focused equally on system stability, which is how much is the risk being taken by the system, is there over leverage, is there operational risk, etc. Issues that could determine the stability of the system and result in maybe banks being in problem, etc. But also customer protection, which is are the customers getting a fair deal and are we being transparent and so on and so forth.
Actually, I'll go one step behind. I'll say that it starts with deciding who's allowed to do the business of banking.
Sure.
The licensing or the chartering aspect
Yep.
of it. Remember good old days when the banking started, the charters were being provided or the licenses were being provided by the governments.
Right.
Or the kings.
Right.
Right? The sovereigns. And the consideration that a sovereign used to have for providing these charter was that how much money am I going to get
right.
in the process, right?
Yeah.
So there was a lot of this vested interest in providing charters.
Yeah.
But over a period of time, the provision of charter or the provision of license has moved from a government to the central bank.
Yep.
And where the consideration is whether it is in public interest.
Right.
Now to allow a bank to function or allow a bank to come into
Right.
So that's the starting point.
Right.
Who can actually be doing the banking business, and then writing the rules about how the banking business needs to be done.
Yep.
Right. And obviously nowadays banks deal with a large, large set of customers.
Yeah.
Banks provide a whole host of services, not just pure deposits and lending.
Yeah.
And therefore, making sure that there is confidence in the banking system. Remember, banking is a confidence game.
Yep.
And therefore, the stability of the financial system rests upon the confidence that public at large has in the financial system. And therefore, the Reserve Bank writes the rules to make sure that the public's confidence is maintained. And that also extends to what is called consumer protection, basically how customers are being treated by the banks,
Yep.
right? So it's a wide continuum, I would say, starting from the charter or licensing to the rule making about how the business of banking is to be done, to making sure that the customers are treated in a fair manner by the banks. This is the regulatory aspect of the bank.
Absolutely.
Central bank.
So fantastic. Great to cover that. We covered all 4 functions of the central bank. In addition, by the way, the central bank also plays a developmental role, right? Quote
That's
unquote. As an example, let's say in India, a lot of the innovation, including UPI, which has done wonders, is central bank had a very strong role to play in it. Our central, like RBI, as an example, has a subsidiary, RBI Innovation Hub, which is focused on ensuring that banking becomes more digital, brings in more innovation, and so on and so forth. So I guess there is that maybe role. Maybe it's not a regulatory role, like it's not comes in those 4 big items, but there is a kind of a exhorting developmental role as well.
If you read about the roles of central bank, they will also talk about the fact that central banks provide research to the markets,
Yep.
right? And a lot of data to the markets to actually help or public at large. So that's the research functionality, as they call it.
Yep.
Developmental functionality, very, very important, and particularly taken very seriously by the emerging market central banks, right? Because where the banking is still not very deep, there are a lot of underdeveloped, underbanked parts of the economy. I think the central banks take their developmental role quite seriously here.
Absolutely.
So yes, in that context, making sure that you have products and services which are available at a low cost to a wider set of population, right? And there is a very deep spread of banking, because at the end of the day, what was true in, let's say, 1668 when the first central bank was set up, to now, the concept that credit is essential for growth, right? Banking is essential for an economy's growth. That was the same logic with which I guess Napoleon had set up his Banco de France in 1800s.
Yeah.
And that's the same logic with which we run banks today.
Yeah.
But ultimately, it's basically providing credit to the economy.
Sure. Great. So Neeraj, we'll shift tracks completely now, and let's talk about, I don't understand this fully, and will be great to get your perspective is on the balance sheet of a central bank.
Yeah.
Which I presume looks very different compared to the balance sheet of a normal commercial bank. So great to get your thoughts. What does it look like? What's on the assets? What's on the liabilities? Where do they come from? What do they mean? Etc. Etc.
Yeah, I mean, like I said, central banks actually effectively started as first being banks.
Right.
So classical bank's balance sheet, if we can take, and then we can morph that into a central bank's balance sheet, right? Unlike a standard commercial bank, a central bank does not deal with public at large.
Correct.
It only deals with banks.
Correct.
Right? Therefore, the assets and liabilities of a central bank are also its relationship with the rest of the banking system.
Right.
So on the liability side, a central bank typically tends to have liabilities to these banks,
Right.
which is basically the reserves that these banks have kept with the central bank.
Sure.
The reserve deposits.
Yep.
That's one source of liability. The second source of liability in most countries, although as I mentioned in US it's a slightly different story, is that central banks actually issue currency
Yes.
notes, right? The currency notes which sit in your or my pocket are actually liability of the central bank.
Correct.
Right? So if you ask me, these are the two dominant sources of liabilities of a central bank.
Correct. In fact, all money in the system outside of that created by the commercial bank is liability of the central bank, I presume. Yeah.
That's right. And that's the definition of central bank money.
Correct.
The definition of central bank money is the central bank's liabilities.
Yep.
Right? On the asset side, central banks typically tend to have 2 or 3 different kinds of assets. Number one, they tend to have, in the good old days, the central banks were required to maintain gold,
Yep.
right? Or precious commodities or currencies, which were equivalent to the amount of notes that they had issued in the system, right? Now, that is no longer the case. So, in most central banks' balance sheet today, on the asset side, you have government bonds.
Right.
The loan or the lending that these banks have given to their respective governments.
Right.
The second major source of asset on the balance sheet is their own investments in the markets, right? And the amount of lending that they have done to the other banks. Now, it's very interesting. Banks borrow and lend from central bank. They lend to the central bank in the form of reserve deposits. And they borrow from central bank sometimes in the form of refinances, specific schemes of lending that central bank may come up with, etc., etc. So on the asset side, the second, though not very large, piece of asset is lending to the banking system that central bank has done. The third is typically most central banks tend to maintain foreign exchange reserves. Right? Why do they maintain foreign exchange reserves? Because governments have foreign liabilities and they want to make sure that there is enough funding available to pay for that foreign liabilities. And today we are in a very globalized world. A lot of flows happen between economies. Each country has its own currency. So central banks maintain foreign assets in the form of their investments in foreign currency. Now, if you look at the balance sheet of a central bank, it's largely financial assets.
Right.
There are very limited hard assets. Central banks, for example, don't invest in property, don't invest, they may own property, but that's not the dominant part of their balance sheet. They don't invest in physical assets, they don't invest in anything else. So it's all basically financial assets. Also, the fact that central banks can actually increase and decrease their balance sheet at will. That is what is the unique aspect of central bank's balance sheet.
So before we dive there, the first question I have is that if all the money in circulation is a liability of the central bank, number one, that's a very large amount, right? Number two, that is a liability without an end date, because a currency note doesn't have
it's a perpetuity.
It's in perpetuity, and we know that balance sheets have to match, like the assets have to be equal to liabilities. So what is the corresponding asset to this on the asset side, which kind of makes this match?
Yeah, so typically central banks would create assets.
Right.
They create liability and they create assets.
Right.
And they can choose what asset they want to create, right? Most of the times they will actually end up creating assets which is either lending to the banking system or lending to their governments.
Okay.
To back this issuance of currency liability.
Right.
Notes in circulation, as we call it. Many times you could also have these notes in circulation backed by foreign currency assets, right? So, but it's all one of these, right?
Right.
And
so every time a central bank creates currency, it will give it to someone by buying something back. It could be a government security. It could just be a loan to, a bank or some other entity, or it could be it's buying dollars, let's say. In which case it's kind of, so every time it prints money, it kind of, hence the asset side goes up by the same amount as the liability side.
Yeah.
The magic though is that they can print as much as they want.
It's the common terminology, printing the money.
Yeah, sure. Yeah.
What it basically means is that central banks have an enormous amount of flexibility of
creating the
managing the size of their own balance sheet, right? And it's this flexibility of managing the size of their own balance sheet which gives them their unique power.
Right.
Interesting aspect. Let me just spend a little bit of time on this to explain. In the good old days, when central banks were starting to issue notes, bank notes, they were obligated to maintain an equal amount of gold in their vaults to back up the gold, right? Which is why the notes was to say, I promise to pay the bearer a sum of X. What that sum of X was effectively the amount of gold that they would have kept. So if you didn't like the face of this note, you could go to the central bank and say, hey, take this note back, give me the gold.
Yeah. So Neeraj, I asked this question to Neelkant also in
Yeah.
one of our previous ones, because
Yeah.
the Indian 100 rupee note or any note still says this. It says that I promise to pay the bearer of this note a sum of 100 rupees. So now if you don't like the face of that note, if you go to the RBI and give them that 100 rupees, what will you get? Because there is no gold right now.
Yeah, you will not get much. You will get 100 rupees back,
Yeah.
which is why
Maybe
the
you'll get
language.
50 rupee notes.
Yeah, which is why the language says I promise to pay a sum of. The old language, if I remember it correctly, used to be a promise to pay a value of.
Right.
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 So there is this subtle change.
Right.
But effectively, many banks have even stopped writing that.
Right.
In fact, I don't think, I don't remember it well, but I don't think US dollar says that.
Right.
Right? So many central banks have even stopped writing that language.
Right.
It is now well understood that it is fiat money.
Right.
The value of this money is driven from the fact that it's legal tender.
Yeah.
And if you refuse accepting this money, you can be in jail.
Sure.
Right? so it's legal. That's the definition of a legal tender.
Yeah.
But going back to the aspect of the balance sheet of central bank, right? So in the old times when we had this what is called a gold standard,
Right.
central banks could not create currency at will. They could only create so many notes as they had gold in their vault.
Yes.
Right? So if for whatever reason the supply of gold increased, the central banks would actually create more money. Or if the supply of gold decreased, they had no choice
But to
clamp
reduce,
down
yeah.
on the money supply in the system. And this model of creating money in the system was what was deemed to be very inelastic,
Right.
because it is not in reaction to the economic activity.
Yep.
It is in reaction to the availability of gold.
Yep.
Right? So the move away from gold standard into fiat money exactly broke away that rigidity of a central bank. Right? It basically allowed central banks to create paper money to the extent that they want, and basically have any kind of assets backing it, including lending to the government.
Right.
Right? And it is this innovation which gives the modern monetary system its unique characteristic.
Absolutely. Moving from the balance sheet to income, there is this, as an example, the RBI pays dividends to the government every year, which means they are creating some money, they are earning some revenues and profits and so on and so forth. Where do these profits come from?
So very interesting. The note that you have in your pocket doesn't earn you any interest.
Right.
But it's a perpetuity.
Yes.
Right? So the issuance of currency notes, which is done by the central bank, which is held by the public at large, is effectively a zero cost liability of the central bank.
Yep.
Right?
Or the cost is of that of printing the note.
Yeah.
Which, let's say for a 100 rupee note, maybe it's like some paisas, right?
In relation to the value,
Yeah.
it is
minuscule.
A very
minuscule.
small amount,
Yeah.
right? So it's effectively a zero cost liability, right? But what does the central bank do with this? It basically puts this money into government bonds,
Yep.
which earn them interest, right?
Yep.
So there is a interest income that is being earned on this balance sheet, which is effectively a zero cost balance sheet. Likewise, when we as banks go and keep reserves with the central bank, it doesn't pay us any interest on
Anything.
it. These are zero
Correct.
interest payment reserve deposits,
Correct.
right? But that liquidity is correspondingly maintained in assets in the form of interest-bearing assets.
Right.
Right? Some of them interest-bearing assets. So the difference between the two effectively means that the central bank is earning a net interest income on its assets versus liabilities, which effectively is guaranteed,
Right.
right, by virtue of its issuance of, by virtue of its role as monetary authority,
Yeah.
right? Now, the level of this income depends upon the level of interest rates.
Right.
Liability cost is zero, asset cost depends upon the interest rates.
Right.
And the level of interest rates in an economy by and large depend upon the level of
The policy rates,
inflation
yeah.
in the economy, right? Therefore, this income is called seigniorage.
Right.
It is effectively, in the good old days, people, the kings used to chip away, metals from the coins. They used to debase the coins which used to lead to inflation in the system, and the chipping away of the metals was called seigniorage income, right? This is effectively a seigniorage income. Now, central bank, being an arm of the government today, 100% owned by the government today, is basically transferring this entire income back to the government as dividends, right? So effectively, this income of running the monetary system of a country, which is a function of the inflation, interest rates in the country, is what the government is earning by way of monetary authority.
Right. So basically, very simplistically put, the act of creating money for the central bank is free. The money itself has value, and hence by creating that money, the central bank is earning something, which is what then translates into its P&L.
So in a very kind of roundabout way, this is another form of inflation tax, right?
It's another.
So the other form of inflation tax, because effectively it's the difference between the two is dependent upon the level of inflation in the system.
Understood. Final question on this topic, Neeraj, which is commercial banks have to keep a level of capital to run their businesses, to manage risks and so on and so forth. Is there an equivalent of this nature on the central banking side? Is there a thought process around this? How do central banks manage their risks, and or do they even need to?
So it's a very, I would say it's a very evolving and a very recent concept, right? Because at some level, central banks are now extended arms of the government, right? And therefore, to some extent, even if they did not have enough capital, it is assumed that the governments will actually put capital into them to make sure that the financial system remains robust, right? But over a period of time, and we had this extensive debate in India a few years ago as to what should be the level of capital that the central bank should maintain to make sure that its functioning is robust, right? Many central banks don't have any norms around it.
Right.
Because effectively it is assumed that they have an infinite draw on the government for funding their losses, if they were to have losses. But in India, we have seen some standards being developed around that. And there is now a well-defined rule that our central bank follows with regard to the capital that it maintains, basis the composition of its own balance sheet. And that capital is basically maintained to take care of the fact that two or three things. One is that it is holding bonds, both domestic bonds and foreign currency bonds, which are volatile in value, whose value can change over a period of time. Right? Second, it is also exposed to currency risk because it is holding certain assets in foreign currency, and the currency values are bound to be volatile. So these are the kind of reasons for which central banks would like to maintain capital. And there are some norms that they have evolved. I don't want to get into the detail of how much norms, because that's too much of nitty-gritty, but there are some norms that have been come about as to what should be the capital of the central bank. But remember, the capital of the central bank is a liability to the government.
Right.
Correct? Because government is the equity holder.
Correct.
Now, whether the government holds the equity directly
or
has given a blank check,
guarantee,
implicit guarantee to the central bank, is effectively the same thing.
Yeah.
Therefore, in many jurisdictions, it's really not important what's the level of the capital of the central bank.
Understood. Final topic for the discussion, Neeraj, is will be helpful just to contrast different types of central banking philosophies, architectures, etc.
Yeah.
And maybe we take, let's say, India, US, and let's say some bank in Europe.
Yeah.
And will be just helpful to talk about similarities or more importantly talk about differences and in how they operate.
So there used to be, when the central banks were evolving, there used to be a European model of a central bank, which was studied, which was basically what Bank of England did, what Bank of Sweden did, what Bank of France did, right? This is a very quintessential European way of doing central banking, which became prevalent. And that was the format of central banking which also got adopted in countries like India.
Right.
So Reserve Bank of India, which was set up in 1936, if I'm not wrong, 1933, right, was modeled around a typical, because we were under British Raj at the time, so it was modeled typically around how UK's Bank of England was set up. But over a period of time, the central banks in US and Europe have become different.
Right.
So let me take the example of US first. Did you know, for example, that Federal Reserve Bank system was the third attempt of US to have a central bank?
Oh, I did not.
Right? So in 1700s, early
Right.
1700s, there was a bank which was chartered, which was called the First National Bank of United States.
Okay.
It was given a 20-year charter, and that bank had charter to run both commercial banking activity and central banking activity, like banker to the government. And there was so much angst against that bank that its charter was not renewed
Right.
after 20 years.
I guess because it had very conflicting
Yeah, I mean,
functions.
US has this, I mean, US had this, there's a very nice paper written by Jerome Powell on this history of banking where he describes why these charters were not renewed.
Right.
Fundamentally, US did not want concentration of monetary power in the hands of one institution.
Right.
They wanted a more distributed setup
Right.
of monetary power.
Right.
So therefore, the first bank effectively was not, was continued, was shut down. The second bank, which was chartered, met with the same fate.
Right.
And therefore, between 1700 to almost 1913, US kind of struggled to have a proper central bank. It was only in 1913 when they agreed to have a Federal Reserve banking system, where they actually came up with 12 Federal Reserve banks. Therefore, it was not one central bank, it was 12 central banks for US, each looking after a particular territory,
Yeah.
but governed by a board of governors.
Right.
So what we call as Fed today is actually a board of governors
The central
of Federal
board of
Reserve.
the Federal Reserve.
That's
yeah.
right. It's the central board of the Federal Reserve banks.
Right.
Not banks.
Right.
Right. And therefore, but the monetary policy aspect is in the hands of the board, right? So that's one form of central banking system which is very unique, very different. The
And there the monetary policy is done by the quote-unquote Fed, the central...
So there is a committee of the board,
right.
which is some members drawn from the board and some members drawn from the Federal Reserve banks themselves, the
12 federal
presidents
banks.
of the Federal Reserve banks. So
Right.
it's a composition of the mix of the two, which forms what is called a Federal Open Markets Committee,
Right,
FOMC,
FOMC, yeah.
which is responsible for the monetary policy.
Right.
Right? So it's again a very, very different
Yeah.
setup. That
And
US
there,
has.
by the way, supervision happens at the kind of the more decentralized level.
Well, supervisory powers are distributed between the central bank, which is Fed, and Officer of Controller of Currency, which is an institution which was set up before the Fed was set up,
Right.
and then the states. And there is FDIC, which is the Resolution Corporation. So it's
Right.
the supervisory powers are actually distributed across
Right.
various arms of the government. right?
Understood.
If you go to Europe, like I mentioned, that there was a classical European model of central banking. But once the ECB came into play, the European Union came into play, it was effectively a monetary union,
Yep.
right? So instead of having, or you still had, individual country level central banks, but the European authority also created a central bank, a Europe level central bank, which was called European Central Bank, ECB.
The ECB, yeah.
Right? So in Europe now you have a ECB and you have a national central bank, and the powers are divided between the two,
Right.
right? So for example, the monetary policy aspect of it, the currency aspect of it, and the payment system aspect of it is largely handled by ECB. Whereas the chartering of the banking system, the banking for the government is actually done by
Each of the national...
each of the national central banks. So you have a two-tier system in effectively in Europe of central banking. Now in countries like India, China, Korea, we have still the classical central bank system where one single central bank looking after multiple functions directly owned by the government, the respective governments, right? The one important aspect which has happened over a period of time is the level of commercial activity of these central banks. Remember, as we started the previous episode, the central banks were actually banks in the beginning.
Right.
Right? And as they evolved into being central banks, they steadily let go of their commercial banking activity, but
Right.
not completely. So there is also a level of difference of what is the level of commercial banking activity that these banks do, although it's kind of minimizing over a period of time.
Understood. Great. Great. Last question, Neeraj, before we end the conversation is obviously kind of a critical role of the central banks is when, obviously one role is to kind of ensure that the business cycles are smooth and so on and so forth, and to regulate and so on, etc. But central banks become doubly critical when the economy hits some stress point, right? And so will be helpful maybe one or two instances of when this has happened, how central bank stepped in, what they did, and how kind of that helped the economy.
I think very classical case of global financial crisis,
Yep.
right, of 2007. As I mentioned, it was like probably the biggest financial crisis that US saw and the world saw in about 100 years' time.
Absolutely.
Before that, in US, you had 1907 financial crisis, which led to the creation of Fed
Of the
itself.
Fed, yeah.
Right? So 2007 financial crisis actually shook the faith in the financial system in a big way.
Yep.
in developed world, right? So financial institutions were under severe stress. So what did the central bank do? In fact, a lot of the activities that the central banks did at that point in time were actually quite innovative. For example, interest rates were brought down to almost zero percentage point across the world, right? I don't think before that central banks had actually gone so much low in terms of their interest rate
And in
policies.
such a coordinated fashion. This is both, it was zero and it was coordinated. So almost all banks
That's right.
across the world kind of got it down.
So it was almost like a global phenomena rather than a single country phenomenon.
Correct.
The second thing that they did, which was actually quite interesting and not many people know about this, that Federal Reserve Bank of US was, or Federal Reserve System of US was kind of criticized in 1929 to 1933 crisis that they were too rigid.
Right.
Part of the reason we had such a big crisis in 1929 in US was because Fed was there and Fed did not provide as much liquidity as it should have or as much activity. So there was this kind of legacy, overbearing thought process. And Ben Bernanke, who was the central bank governor at time, was a student of the 1929
crisis, yes.
right? So he carried over that lesson into 2007-8 policy handling, where he said that he'll go to any extent to make sure that the system does not go into collapse. And that would include even printing money and throwing it from a helicopter in people's hands, right? And which is why the concept of helicopter money,
yes.
which he took. Incidentally, Ben Bernanke won 2023 Nobel Prize in Economics for all the activities that he did as a central bank, as a Federal Reserve governor, right?
Yeah.
So it was a pretty interesting time in how central banks actually took their mandate of economic activity, not inflation, but economic activity seriously, and went to a very deep extent, coming up with policies, processes, instruments to provide the stability and the liquidity to the system.
And I guess what about India? In India, I guess the equivalent would be the AQR as an example.
Yeah, AQR is more regulatory. AQR was basically done to create some kind of a confidence in the banking system. If you recall 2013-14, there were a lot of these issues, about what is the real level of NPAs sitting in the banking system. So the idea of AQR was to basically stress test the bank's balance sheet and see what is the level of non-performing assets that they are having. If they indeed are having non-performing assets to a certain extent, then get them to clean their balance sheets.
Bring
it's a
capital
cleanup
and,
exercise,
exactly.
Effectively cleaning up the banking system. Remember, a banking system which is saddled with non-performing assets is the biggest drag on an economy. We've seen that happen in Japan in late 80s. So we obviously did not want a repeat of it. And a similar exercise, by the way, was carried out by ECB and Fed in, I think, somewhere around 2008-9 or later, in response to this whole issue of what is the level of problem statement in their banking systems, right? So they carried out stress tests, say in a very sort of similar fashion to figure out what's the level of capital. So that, to my mind, is much more of a regulatory financial stability aspect of a central bank's activity, right? Which they did, just to make sure that the system is clean and public at large has confidence in the quality of banks' balance sheets.
Fantastic. Fascinating conversation, Neeraj. We covered various aspects of the central bank. We started with the history, we covered the monetary element of this, and today we covered all the other functions. We also spoke about how central banks differ in what they do across the world. We spoke about central bank balance sheets and how they create money. And lastly, we also spoke about a couple of examples where central banks have stepped in the time of crisis and helped economies kind of come back to normal operations. Very interesting conversation, Neeraj. Thanks a lot for your time. And kind of I hope you enjoyed the show.
Yeah, it was a fabulous conversation.
Yeah. Thank you.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.